Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment podcast. My name is Jeb Graham. I'm here with Eric Wymore and Ethan Hutchison, who are co-hosts and partners with Metcalf Partners and on the podcast. And today, what we want to talk about is, at Metcalf Partners, we get a lot of clients that ask us, who our kind of core market is and who we work with the most. And we've always defined it as three key clients. If we're going to kind of identify and break them down, they usually fall into one of three buckets, right? And one of which is going to be what we call our emerging affluent clients. And that's going to be a younger person that's maybe a higher earner that wants to put together a plan, maybe doesn't have a huge asset base right now, but that's kind of a great long-term client for us, and we can really help that person over the years. Then we have what we call our at or near retirement client, and that's someone that's maybe within 10 years of retirement. They've got a nest egg put together, and they're just looking to figure out how to retire and put all the pieces of the puzzle together. And then the third one, and this is the one that we really want to focus in on today, and if I'm being honest, it's one of my favorite type of clients to work with, is the business owner client. And when you look at a business, I'm talking about a small business owner. There's a lot of different things that we can do for a small business owner, and a lot of ways that we can help them, whether it's to save money on taxes, to just kind of get started and putting away a nest egg, to exiting their business. So that's the third bucket. And today we really want to focus on a few key areas that we work with small business owners in, so that we can basically let our audience and our clients know what we can do for them. So today what we're going to hit on is first we're going to hit on the different types of retirement plans. We've recently had Casey McCarthy, who is one of our partners at EIP on, who talked about retirement plans. Ethan's going to hit on some retirement plans that we do that don't require a third-party administrator. And then Eric's going to hit on some insurances that we do. If you think about a business, you've got key employees, you've got a lot of insurable interests, and we can certainly help through those. And then after that, I'm going to talk a little bit about exit planning. We've been fortunate enough, and our clients have been fortunate enough over the last 5 years to work with several clients that have exited their business, and we've learned some tricks of that trade as well. And so those are kind of our main pieces with business owners. And I think we're going to go ahead and start. Let's talk about different retirement plans that we do as an organization.
Yeah. There's three main employer plans that we'll work with: the solo K or the individual K, the SEP IRA, and the simple IRA. A lot of times when we're working with business owners, they might be 10 years into owning that business and they still haven't set up, their retirement plan for that business. And they're just saving money into a pre-tax traditional IRA, or they're looking at a joint account and they're just putting the minimums or the maximums into those accounts. And for reference, an IRA, the most you can put into an IRA is just around $7,000, give or take, depending on if you're over or under age 50. So where we like to start is understand the client's business structure. How many employees do they have? Is it an S corp? Do you pay yourself a salary? So there's a lot of underlying questions, and we work really closely with our clients' CPA teams as well to kind of dive in and really understand the business. The first one I'll talk about, it's one of our favorites. It's called the solo K or an individual K. The K at the end of that, it's 401k. And you can have this plan, this solo K, if it's just you in the business. There's a caveat. If your spouse is employed, they can also have a solo K that's attached to that business. Think of this as a lower cost 401k for your business. Again, two people in the business, husband and wife, spouses together, they're going to be qualified. They're going to be qualifying contributors to this plan. The solo K acts very similar to a 401k. So your max employee deferral is going to be $23,500 for the 2025 tax year. The employer can do a profit share on top of that and put up to $70,000 total inside of that solo K. So for a husband and wife that are running a business together, they can put about $140,000 away into these plans. So very, very unique. Also, all these plans we're talking about today have a Roth component as well. So you can get a pre-tax contribution and get a tax deduction in the year you make that, or you can just go ahead and pay your taxes and get some Roth dollars in there that you never have to worry about taxes again. So solo Ks are really, really unique because there's a lot of flexibility that we have with our clients, and we work really, really closely with the CPA teams as well. Personally, that's my favorite one. We really love working with clients that are just like husband and wife or really, really small business owners and can really show them the impact that those solo K contributions can do for them over 20, 30, 40, 50 years.
And I don't know if you hit on this too, but the other thing we love about solo K, right, is that you don't have to file a 5,500 until you get to $250,000 in there. And then it's not a real 5,500, if you will. It's a 5,500 easy. So it's something that the business owner and their accountant can basically fill out and send into the IRS. So that just makes it a lot less costly to administer, right, than what a full 401k is. And I'm with you, Ethan. That is my favorite plan to do with a client, just because they can put away so much money. There's so much tax benefit, and it's just not costly. It's just easy. So.
Yeah, and the costs deter a lot of folks from signing up for a 401k. They think, wow, this is going to cost me, $20,000 a year to keep this 401k up and running. And the reality, there's so many tax credits and tax incentives that are out there that the IRS has blessed through the Secure 2.0 Act that, as Casey alluded to in our previous podcast, you could start a 401k for your company and it's virtually free for about 5 years or so. So there's a lot of tax credits and incentives. And for the really small businesses that are opening up SEPs and Simples and solo Ks, very, very cost efficient. So don't think that you're going to be paying out the wazoo to have these plans in place. They're extremely beneficial and very, very low cost. And a lot of times the costs that are associated with them are tax deductible to the business. So if you're doing it the correct way, you can kind of use that to your advantage when you're setting these plans up. The next one that we'll talk about is a SEP IRA. This one's a classic for just self-employed folks and small business owners who want to keep things very straightforward. The contribution limits for a SEP IRA for 2025, you can contribute up to 25% of your compensation with a maximum limit of about $70,000 per year. These are employer-only contributions. So if I'm an employee at a business, I can't make contributions to that SEP. My boss or the business owner has to contribute on my behalf to the plan. Very, very low cost, super simple. There's really not a lot to these. And actually recently, given all the new legislation that's come out, and I haven't seen one of these yet, but you can do a SEP Roth IRA as well. So that's unique. And again, it's a great way to get Roth dollars in there.
And that's new, just 2025. The SEP Roth is new in 2025, right?
Yeah.
So
very, very
I haven't
recent.
seen one yet either. So,
Yeah,
but that
haven't seen them.
That's
And
a big benefit for someone that's doing a SEP for sure.
yeah. And Casey mentioned that in our podcast. It's the Secure 2.0 Act. There's 95 provisions in there that really affect employer-sponsored plans. And there's really only 6 to 7 that are enacted. So there's a lot of stuff that's in there that we might see in the next couple years or so, but nothing right away. And Roth SEP IRAs are one of those. Again, very low cost, very straightforward, and super easy to set up. The last one we'll talk about, and we do see these fairly often because they are typically for teams or businesses that have more than 2 employees. The simple IRA. Contribution limits for a simple IRA in 2025 are $16,500. So more than an IRA, less than a 401k. So think about this as kind of right in the middle of the road. Reporting on these is super easy and straightforward. The legislature and the legal and the actuaries, there's not much that comes along with these plans. It's kind of just like setting up an IRA for your employees in your business. It's a bit scaled down than a 401k, so there's not a lot of different components that are in there, but the investment options are very fluid. You can invest in, a lot of anything under the sun for the most part you can put into a simple IRA. Over age 50, you're allowed a $3,500 catch-up contribution. This is unique. Between the ages of 60 and 63, you have a $5,250 catch-up contribution, bringing the total possible up to about $21,750 into a simple IRA. The employer gets to pick two options when you set up a simple IRA. So there's a 2% compensation automatically contributed to the simple IRA, and the business owner can elect for a non-elective deferral of 2% into the simple. And the other option is a 3% match to whatever the employee contributes to those plans. Very, very low cost, super straightforward, no IRS filings like the 401k. The big downside with simples is the contribution limits. As I mentioned earlier, with SEPs and solo Ks, if you structure them correctly, you can put about $70,000 away into these things. The simple IRAs, they have a very relatively low cap of about 16.5 from the employee perspective, and then the match on top of that. So all things considered, the simple's the lowest contribution limits of these, and the solo K and SEP being on the higher end of those.
The great thing about the simple, though, is I feel like really the place there is for a business owner that's not as worried about stocking a bunch of money of their own away, but is really wanting to provide a benefit to their employees. And maybe their employees aren't at an income level where they're going to ever probably exceed those contribution limits anyway. That makes their life a lot simpler. Well, hence a simple IRA, right? It just makes their life a lot simpler than having to go through the 5,500 filing and making sure that you're in compliance with the IRS every year and whatnot. So
definitely.
So I think but those are all awesome options, for business owners. And I think there's a lot of diversity to those. And I think each business has the thing that fits them the most, for sure. And that's something that we can help walk a business owner through and that's a big part of what we're doing with business owners, is trying to help them figure out which one of those plans makes the most sense. And I know, Eric, we were talking yesterday, and we kind of went through some different insurances and stuff like that. So let's talk about that. Key man, all that stuff that's so important for business owners that a lot of times they don't think about until it's too late sometimes, right?
Yeah.
So, yeah.
Yeah. You take them through, kind of the second step and, during this process, and you're looking at some kind of a risk management or executive compensation that's kind of go hand in hand. And usually the first thing that comes to mind is a key man or key person type of an insurance policy. And if you think about what is a key person, well, that might be, an individual that is integral to your business. That might be the C-suite, that might be the CFO or COO or that top salesperson, or maybe have someone that's, an intellectual property. And this is the person that if something happened to them, it would take some time to replace them. And so oftentimes a business will put in what's called a key person or key man insurance plan, where they actually purchase an insurance, a life insurance policy. Oftentimes it might be a term insurance policy, or it could even be a permanent policy on that individual, that in case they pass away unexpectedly, now the business will have some funds to go, to utilize to maybe pay off a beneficiary, or buy them out, or so on, of the business, or to have an extensive executive search to find their replacement. So it's a great way for a business to utilize a small dollar amount in an insurance policy to ensure that if something happens to that key person, that they can take the time and won't have a large revenue loss to find that person. Typically goes hand in hand is when you have that key person, you want to keep them. And by doing that is oftentimes you'll have some kind of a larger or an executive compensation plan. And that's usually some kind of it's called a executive deferred comp plan. So typically this is an individual that will make a little bit more money on a regular basis than the average employee. And they may already be maxed out on all their 401ks and their Roth 401ks and so on. And here's another way for them to defer their compensation for future payments, right? So you're going to take a little bit less income this year, and you're going to defer it for a future payment out in the future. A lot of corporations have this where, an employee will will designate how much they want to save at the end of the year for the next year. And then each one of those deferred compensation plans will pay out, say, 5 years after they separate from service. So it's a great retirement to kind of bridge that gap, a retirement plan to bridge that gap between when you're done working, maybe take a little bit of time off before you want to start drawing down on your retirement accounts and so on. Plus, there's a couple of different things that are involved in there. There's other supplemental, it's called a CERC, and we won't go into great detail, but just kind of get that general idea. If you're a highly compensated executive and you've already maxed out on your 401ks and your other retirement plans, and you want to defer some of your comp to lower your current income tax bracket, there are ways to do that.
Mm-hmm.
Now,
I will tell you too, like from my perspective, like when you look at that, you're kind of killing like multiple birds with one stone right there, right? Like if you're a business owner, number one is like an example that I would think about would be like someone that's a salesperson that is generating millions of dollars of revenue for your company, right?
Mm-hmm.
And if that person dies, that's millions of dollars of revenue that you're missing out on. So that's a big time insurable interest right there, right? So now you're buying a life insurance policy that's going to help you as the business owner if something happens to them. But then you're also using that policy as a way for them to be, having a big bucket of money for saving for themselves in retirement. And so in essence, you're protecting yourself. And then by the way, when they retire, they can keep that life insurance policy to basically, change the beneficiary to a family member. So there's just a lot of diversity there. And I feel like personally, I feel like that's an underutilized tool for business owners, in my opinion.
Yeah, I would agree. I would absolutely agree. And kind of the third and final topic that we'll like in this that we'll talk with business owners on, and this kind of risk management, executive compensation is usually there's some kind of a buy-sell agreement. So imagine if you have several different owners in a business. I think the fear is that, one of them passes away and then all of a sudden you become in business with their significant other or their children. And, what a buy-sell agreement does is it puts in some kind of a legal binding contract that says if there's a triggering event that happens, then here are the players that will be purchasing the business. And, those triggering events are often, some kind of death or disability, retirement, or some kind of other, decision to leave the organization. There is already an agreement in place to who buys out the shares. And there's different valuation methods that are going to be put into that buy-sell agreement. There's different ways to fund it. Oftentimes, in the beginning stages, it's funded with a life insurance policy. What a cheap way if you've got a business that's worth $1 million and there's two owners, rather than having each of them have $500,000 sitting aside to buy out the other member, you can easily buy a inexpensive term life insurance policy for $500,000 on each one of their lives. The business owns the policy. When something happens to the owner, they'll receive the funds. They can buy out the shares. So you retain the ownership of the business, and you're not having to worry about, again, going into business with the beneficiaries or the spouse. But again, those are conversations and that provide that continuity in the business. If something were to happen, there's plenty of risks out there. And this is just one way. These are three elements that we use a lot of times to help kind of mitigate those risks as we sit down with business owners in our practice.
Yep. And I know to your point, like obviously a buy-sell agreement, that's not something that we do here, right? We don't write up the agreement, but we have attorneys that we work with. So when we get a business owner, we're going to go to an attorney, and where we're going to come in is we're going to help with how we're funding that, right? We're going to basically help with that life insurance. And, but again, it's not an uncommon story that somebody doesn't have a succession plan in place and something happens to the business owner or a key employee and they're kind of in a pickle. And so I think helping the business owners prevent that is at least starting the conversation of a buy-sell agreement and how it's going to be funded and all that is a big piece of where we're working with business owners. And so moving into to kind of the last thing that we can all talk about is exit planning, and that's something that is exciting, right? And I would say that every business owner, their dream is kind of that final exit someday. And and maybe not every business owner, but I think that's pretty prevalent, is people kind of have this idea that they're going to work, they're going to build up this business, and then they're going to have this kind of glorious exit. And we've seen a few of those glorious exits over the last few years. And what we've learned is they are glorious. It's great and it's a glorious exit, but there's a lot to think about in a business sale. And it's not as easy as I work for 20 years, I sell my business, I get a big chunk of cash and I move on. There's a little bit more to it than that. And I think a few of the things that we can talk about is kind of what type of, how people are selling businesses and what type of business transactions that we're seeing. And I'd say that most of them fall into one of three categories. One of those categories would be internal succession. Okay. So if you've got, basically the business owner and you've got a couple of other key employees, a lot of times they're just over time going to shift the ownership from themselves to other key employees inside of the organization. That is great for continuity, right? Because the people have been in the business for a long time, they understand the business, and they're probably the most prepared to be able to move it on after the initial business owner is gone. And then we're also seeing people, maybe they don't have that internal succession plan, so they're going through business brokers, right? So there's a lot of business brokers out there. You might list it with a business broker. They're going to try to help you find a buyer. They're trying to match buyers and sellers. And they do take a commission typically when they do that, but that's one area we're seeing. And the third one, and we're seeing this in many, many industries, and we've been through several of them in the last few years, where we have clients that are bought out by a large private equity organization. And private equity, if you don't know what that is, it's basically just an organization that's not publicly traded, that's buying up smaller, non-publicly traded organizations and kind of wrapping them up and aggregating them up into one larger entity. And oddly enough, the environment has been very, very favorable for those organizations for a number of years. We've had very low interest rates. People have had a lot of cash on hand. So it's basically been kind of a heyday for some of these private equity organizations. And so that's what we're seeing. And we also see kind of two different types of sales. One of which could be the two main ways that companies sell are one is a multiple of gross revenue. So I would say in our business, smaller organizations sell at a multiple of gross revenue. Okay. So if you're doing $2 million in revenue and you're in your industry, they're selling at 2.5 times revenue. Well, that's a $5 million transaction. It's pretty easy to calculate. But then there's the more complex ones, which would be as a multiple of EBITDA, which is basically the profitability of the organization. And when you're selling on the profitability of the organization, there's a little bit more involved in selling, right? Because what you're doing is you are wanting to make your organization as profitable as possible, meaning a lot of times they're scaling down expenses and kind of cleaning out expenses in the years leading up to selling the organization so that they can sell on the very highest multiple of EBITDA as possible. I feel like in the private equity world, that's what we're seeing more of. And some of the numbers that we're seeing are pretty ridiculous, right? As far as multiples of EBITDA, a lot of times it can be 10 to 15 times EBITDA, depending upon the size of the business, even higher than that in certain circumstances as well. But so from the business owner, once you kind of figure out how you're selling and what you're going to do, some other key considerations are there's always tax consequences, right? As I think a lot of people don't realize how low typically their basis is in their business. And that's what I've run into anyway. A lot of the times these things are selling with almost no basis. So if you have a $5 or $10 million transaction, you may be on the hook for the capital gain on the entire amount of that transaction. So planning accordingly for that is very, very important. Okay. The other tax consideration, which I would say is where we come in as advisors, is people get this lump sum of money. They want to generate an income off of it. Well, they need advisors like us to manage that money, grow the money, generate income off of the money for them over time. And making sure that you have an advisor that knows how to do that in a tax efficient way is very, very important. There's direct indexing options now. There's a lot of different things that you can do as someone that has a large lump sum of money and tax harvesting, just to make sure that you're tax efficient with how your dollars are invested. And then, so the tax efficient reinvestment and just knowing your basis, I think calculating and knowing your basis. And then lastly, I guess the thing that I would talk about is just structures of deals that we're seeing. And back to kind of what I was saying in the beginning, where I think a lot of people have the perception that you grow the business, you sell, you get a lump of cash and you walk away. And typically, specifically in the private equity world, and I would even say in the internal succession world, and maybe not quite as much as in the business broker world, but many times you're getting, if you do a $10 million transaction, a lot of times you may get $5 million or $7 million up front. And then a lot of that other payment is deferred based on the income of the organization, staying where it is or growing. And sometimes there's even additional monies for growth in that first few years. But a lot of times they're wanting to retain that business owner for 3 to 5 years. So if you sell your business, you might be working for 3 to 5 years for that organization, or maybe even indefinitely. And they want that because that's what really creates that continuity, for the next owner of the business, is that it's not just hey, I own it one day and somebody else owns it the next day. See you later. That's a tough way to sell a business, because I think there's a lot of risks with that, because you can end up, losing clientele because maybe they have a great relationship with the business owner and so on and so forth. But I think, like, when you think of all these things, the key is if you think about wanting to sell your business and you're going down that road, the time to think about that is now, right? Even if that's 10 years from now or 15 years from now, but start thinking about either your internal succession plan. If you think you're going to go through the business broker or do a private equity transaction, do your research, and we can certainly help you with that on how those transactions happen, what needs to happen now to kind of set yourself up to be in the best possible position to have that successful exit and transition. So
Absolutely. You took multiple years to grow your business. It's going to take a few years to unwind it or to exit it. That's for sure.
Exactly.
Don't call us in July and want to sell in August.
It's tough. And I think that's kind of natural. I think some people just do that. It's like they work and they work and they work and they get to this point where they're like, well, I'm done. I'm ready to move on. And the reality is it takes a little bit more planning than that for that exit to make sure that it's successful. So,
well, I'm going to touch on that private equity deal a little bit. I mean, we've been pretty surprised recently at how large some of those numbers are. And you start breaking it down with some clients and you're like, well, okay, I kind of want to be out of my business in 5 years. Well, you start looking at some of the private equity deals and it's about the same. If you were to say, hey, maybe now's the time, like if I were to go out sooner than that, I'm still going to get compensated, for that amount or for that time. And so it's the sooner the better to start engaging or having some of these discussions and building up like, strategies and ways to implement them, for sure, is really important.
Yeah,
absolutely.
Understanding the options. I mean, at the end of the day, it's your business. So if you don't want to sell it to this person or this entity because you don't like those terms, and you don't have to engage and move further. So ironing that out and figuring out what's best for you and your family well in advance, so that you can go to the table with, hey, here's what I want and here's kind of how we want to structure this. And just having all that stuff well in advance just makes the process so much easier for everybody involved.
I agree. Well, I think this is a productive day, or a lot of good conversation, and hopefully there's a few business owners that can take some of this stuff and implement, something into their business that maybe they haven't done yet. And we would certainly welcome the opportunity to talk to anybody that's thinking about any of these things about that subject matter. So thank you for joining. And this is Metcalf Money Moment, the podcast, and we're signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management is are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.